Thank you all obviously for joining this afternoon. My name is Richard Flahive. I'm CIO at Hightower Westchester, and tonight we have a special guest with us, Stephanie Link. Stephanie, welcome and thank you for coming on.
Thanks for having me. Great to
Absolutely.
be here.
And for those of you that don't know Stephanie, she joined Hightower in 2020 as our chief investment strategist and portfolio manager. And prior to Hightower, she was many places, senior MD and head of global equity research at Nuveen, among other past experiences. But I imagine a lot of you know her as a regular CNBC contributor on the halftime report and things of that nature. So thanks again, Stephanie, for joining us. But let's jump into it. 2023, interesting year. We witnessed pretty much our entire industry predict a recession, only for it to not come to fruition. Looking out into 2024, obviously a lot on our plate: inflation, rates, presidential election, but we seem to kind of be tracking a soft landing. I mean, what are your initial thoughts as we kind of move into the new year here?
Yeah, so what a year last year was. Lots of surprises. It wasn't just that most people thought this time last year we'd be in a recession by now, this year. But we also had such a narrow market in terms of what the participation was. I had thought that we would see a slowdown last year into this year, mainly because you had so many interest rate hikes from the Fed, and we had such nice momentum from all of the economic stimulus that was put in place way back in COVID years. But I think you know this, Richard, just as well as I do, that when you put fiscal and monetary policies in place, it takes a long time to get into the economy and into the system. And back in COVID, peak of COVID, 2020, I'll give you the stat. It's sort of interesting. If you add fiscal and monetary policies together, it was 60% of GDP. So they put all this money into the economy because they had to. We closed the economy down. So just by reference, back in 2008, the great financial crisis, which was a crisis, by the way, we had two big banks fail. The Fed, the fiscal and monetary policies that were put in place equated to 5%. So just to tell you the magnitude of the liquidity and all that money and easy policy that was put in place, which was a great thing. We needed to do it, and it worked because we did see a V-shaped recovery as a result. But that tailwind has been longer than most people have expected. In addition, last year we had $2 trillion of infrastructure spend, a bill that was put in place, which, by the way, has not even entered into the economy yet. So we have nice positive events that are happening to our economy, and that has led to better than expected earnings, that has led to better than expected growth. First quarter of last year, we grew 2% in GDP, in growth in the economy. The second quarter, 2.1. The third quarter, 4.9. Yeah. And now we're looking at about 2.5% for the fourth quarter and tracking at about 2.5% for the fourth quarter. This is really good news. This is soft landing, Richard, to your point. And not a lot we're expecting it. I think what the bigger surprise last year was that we had such a narrow market with the Magnificent Seven, the technology names, Google, and Amazon, Microsoft, Alphabet, etc., that accounted for 80% of the total returns in the market. So it was very, very narrow, a little bit frustrating for us PMs that have to actually beat the benchmark, which is the S&P 500. The top 10 companies in technology right now equate for 35% of the S&P. Yeah. So 35% of the markets are dominated by such a small amount of names. And I understand why. I mean, the excitement over AI is definitely something that we should appreciate and respect. However, I think this year what happens is we start to see a little bit of a broadening out, a little bit more diversification. That's not to say Magnificent Seven can't do well, but I do think you're going to see so many other sectors and companies that do better, maybe not as well as Mag 7, but they'll do better. And that is because, again, I mentioned the economy is strong. And why is that important? Well, it's important because it impacts earnings for companies. If the economy is doing well, sales should come in better than expected, and we have lower inflation. That should help margins. And so you add it all up, and you should see many other different sectors do better than last year.
Yeah, and not to oversimplify it, but I think if you focused on inflation and kind of earnings revision last year, you got it right in a
Yeah.
sense, right?
Yeah.
It's funny, we tend to gravitate more towards active management, much like yourself and what you do, but you can't help but think of the proliferation of ETFs and passive investing. And for the new average retail investor that's coming in, when you're coming into a cap weighted ETF indice, you're just pushing these bigger players higher. And I think sometimes we underestimate that in a sense, but
Absolutely. I think you're spot on. And in fact, what was interesting most of the year, you're right, it was the market cap weighted stocks, the big 7, 10 really carry all the weight. But what you noticed this too, that it started in October, the equal weight S&P 500 actually outperformed the market cap weight from October until the first part of January. And so you did start to see a broadening out. However, in the last couple of weeks, we've started to see the Mag 7 and market cap weight do a little bit better. I just think it's not all or none.
yeah,
I think it's a little bit of, I think we've got to be, and you're active managers too. I'm an active manager, and I think it's a great stock picking environment, and that hopefully will create alpha for this year.
yeah, you would assume so, right?
Yeah.
So I
Hopefully.
guess, yeah, exactly. And we'll get to the Mag 7 and all in a second, but wanted to touch on Powell and kind of the Fed and all, and their ability and what they're trying to do is obviously avoid this whole stop and go, inflationary monetary policy of previous inflation cycles. And for those on the call, this whole stop and go, as economists have now kind of called it, was back in the 70s, right? During the go periods, the Fed would lower interest rates to kind of loosen monetary policy. And during the stop periods, they raise interest rates to kind of reduce those inflationary pressures. And as a result, they kind of lost the anchor on inflation. Thoughts with that kind of in the back of your head? Does that make you think higher for longer? And kind of how would you grade the Fed and their decisions, thus far?
It's a great question, and I think about it a lot. I give the Fed an A+ for May of 2020.
I'm
So
watching Bill Gross over here saying they've done a terrible job.
well,
Yeah.
May 2020.
Sure.
That's where I give them the A+. When the country shut down, and they threw the bazooka of every single thing that they could, because the bond market was starting to teeter. You saw it. That's why the markets crashed quickly. So I give them an A+ for the efforts that they did, and they recognized the importance and the relevance of what they could do to actually help just calm things down. And it did, it worked. I give them a D for overstaying their welcome, for talking about transitory inflation, for not seeing that. We should have been lower. We should have been actually raising rates. We lowered for a long time, and we had QE for a long, long time. We should have been starting to raise rates at a more gradual basis, probably a year before they started.
Sure.
And that they did not do. So that's why I give them a poor grade. But it's a hard job, and we know there's a lot of moving parts. What I think right now is we have a very interesting situation where you have the bond market is telling you that the Fed is going to ease 6 times. I don't think that to be the case. There's no way. That the economy is too strong. Inflation is coming down quickly, but that has led to easing of financial conditions, which is another reason why, in addition to all the stimulus that we have put in the market and the economy, why we are seeing the market and the economy do much, much better than expected. So to me, I think it's important what they do from here. Again, I do not think 6 times in terms of cuts this year, maybe 3. That's okay. We can handle rates being in the 4% range, 3 to 4% range, especially since you have such a lot of this stimulus still yet to come into the economy and help in terms of offsetting the restrictions on interest rates. And the bond market's telling you that yield curve is still inverted, but it's getting steeper.
Yeah. It's funny. I keep thinking to myself, right, there's this, expectation of what, 140 basis points worth of cuts or something along those lines. Well, if that expectation gets cut in half, what's the perspective of the market, and how does that impact equities? And to me, I think, we're such short-term investors in today's day and age. could we see a swing to the downside, right? That's just something at least we were talking about in our kind of investment committee the other day. So
And I think that's why you've seen the market kind of being all over the place this year
yeah,
so far. While you have, and by the way, why Mag 7 has actually reasserted itself in the last week and a half. It's early on in the year, and we don't want to kind of extrapolate too much, but I think that's exactly what's going on. The market is kind of struggling with, we rallied 9% from the October lows, broadened out because we thought rates were going to come down a lot quicker than expected. And then all of a sudden it's the reality of maybe the Fed doesn't cut as much. And so what does that even mean? Maybe you see a little bit of mean reversion because Mag 7 lagged into the end of the year. So now the broadening out has kind of stalled out a little bit because of this. And so I think you're kind of seeing the market trying to digest things. That being said, I think earnings carry the day over the long-term return. It may not be short-term, but if earnings come in like I think they will, especially in other pockets of the market, I do think you will see a little bit of a better market rally. Again, not 26% rally year to date, last year, and not rally so far. But I do think, though, that we have to keep things into perspective. 2 years ago, the S&P was down 18%. Last year, the market was up 26. The long-term average of the S&P 500 is 7.7. So if we were to get an 8% rally this year, 8, 9, 10%, that's not a bad return. That's not a bad outcome.
Yeah, some sense of normalcy, right?
Exactly.
Yeah. So you mentioned earnings. We're kind of in the middle of it now. I know we have the Mag 7 are predominantly next week, but thoughts on kind of projections. Q4 GDP seems to be kind of where we thought, but I heard the Fed chair John Williams speak up here in White Plains last week, and somewhat muted, right? 1.5%, 2% for 24. I mean, just thoughts on kind of how things are at least looking as we get into earnings season here.
I think I try to take the Fed governors speak with a grain of salt.
Sure.
Because last week, what I thought was pretty interesting, we had Fed President Waller say, the economy is almost as good as it gets. And I'm thinking, well, that actually is, to me, glass half full person. Oh, that's pretty good. Glass, yeah, okay. We're almost as good as it gets, meaning 2-ish% growth, lower inflation. We're going to soft land. Earnings will hang in there, and we'll see the broadening like we were just talking about. Then you have, this week, and you have other people, Fed governors speaking, and they all have their own opinions. So my point being is, let's just step back for half a second. Why is the economy doing well? The economy is doing well because consumer is 70% of US GDP, and they are consuming. And they're consuming, buying, because they have jobs. We have 1.2 jobs available for every one unemployed person. Wage growth is at 4%. Pretty good. Long-term average is 2. So inflation's coming down. Gasoline prices are down. Commodity costs are down. Natural gas is down a lot, double digits.
Mm-hmm.
So I think the consumer feels better, and that is translating into better confidence of the consumer. And oh, by the way, last week we got retail sales, which grew 4.4% year over year. Online grew almost 10%. But you know what's interesting? The goods part of the economy also rose more than expected. So what I think is going to happen with the consumer, I think they will stay strong, solid, maybe not as strong as we saw coming out of COVID, but they'll be strong, which is good. I think there might be a shift. We have seen such robust growth in the services part of the economy, as you would expect. We were cooped up for 3 years. So we got out and we spent on trips and restaurants and this and that. And I think that'll stay strong, maybe not as strong. But I also think you've had massive disinflation in goods. And I think you're going to start to see that increase a little bit as well. And that is because these companies that sell goods have lowered their inventories dramatically over the last 3 to 4 quarters. They had to. It's funny, I often think back at, so Target is a company I follow just because the CEO is so brilliant. And they really had a hard time last year. And he said the reason they had a hard time last year is because their inventory, it was all merchandise, sweaters and jeans and private label, all kinds of things, when people really wanted suitcases and suntan lotion.
Sure.
And he actually said that on a conference call. And I said, oh my Lord, okay, we get it. So we had this massive shift to services from goods. And I think you're going to see a little bit more of a balancing act this year. but I pay attention to the consumer, again, because it's such a big part of the overall economy. And I also think the economy is doing better because we're having a mini renaissance in industrials manufacturing. And it does tie to the infrastructure spend bill that we got passed last year, but that is yet to even be part of the liquidity yet, because it hasn't really even filtered in.
Yeah.
And so what you're seeing themes like onshoring, reshoring, as companies, manufacturing companies they got burned. As you know, they got burned in COVID because they had supply chains in China. And so the past year and a half, all of these companies are shifting all kinds of manufacturing facilities into the US, oh, by the way, into Japan, which are seeing record highs in their markets, and around the world. And that's because the companies got burned, they need to diversify. And so that's what they've been doing. But that's helping our economy as well. And we know in the manufacturing industry, for every one job that is created, 7 other jobs are created around it. And it takes 3 years to build a manufacturing plant. And you don't just build a plant and stick stuff in it, like semiconductors and autos. You actually have to have the materials to help build. And so that has such another multiplier effect. And so I think consumer and manufacturing are really the ones that are the areas of the economy that are doing so well. And that is why we have such momentum. And I think that's frustrating the Fed to a degree, because I think it's kind of keeping a little bit of like a floor on where inflation can go.
Sure.
But we have gone from 9% in inflation and CPI a year and a half ago to 3.4%. So we have made enormous strides. And I think companies and consumers are feeling pretty good.
Yeah. Yeah. I mean, if you think about the consumer, we all underestimated the consumer to a certain extent, right? And I think, to your point, the 70% number of the economy is pretty powerful. I mean, it seemed like everyone was going to Italy at some point in the last 18 months. Right? I guess looking to kind of the stock market valuations, obviously, you look at the PE ratio on the S&P, it's relatively high from a historical standpoint. I mean, where are you kind of finding opportunities and value out there? I know, obviously, the world that you play in is a little more core. I think when we look at where we're allocating, we look at those valuations and tend to know what happens on the other side of those valuations. We're well aware of what happened with the broadening out, but, I know you talk, energy and kind of some of the renaissance we're seeing there, but happy to hear your thoughts on just kind of where you're kind of putting dollars in front.
Sure. So couple themes that I like for this year. Perhaps maybe one of the more contrarian is housing.
Sure.
We have gone from an 8% 30-year fix to about 6.5%, and we've seen mortgage applications rise 4 out of the last 6 weeks as a result. I'm not talking about the home builders. They had a great year last year, a great year. But I'm talking about the home improvement companies, and that's that theme. Because whether or not we get a recovery in housing, we do know that, which would help the home improvement companies. We also know that if you're not going to move, you need to fix up your home and that sort of thing. But here are kind of the stats on housing. We're 5 million homes short in this country. We have 5 million millennials that are just starting to buy for the first time homes. We know from the home builders, they tell us that for the last 13 years, they've underproduced. So the supply is not as great as demand. And we just came from a recession last year in housing, because the Fed that's the one thing that actually worked. They raised rates and they slowed down housing. Sure. And why is housing so important? It's only 10% of the economy, but there is a multiplier effect, just like manufacturing, right? You buy a home, you buy stuff that goes in the home. You buy stuff that goes outside your home. You buy an auto to get from your home to some place where you got to go. And by the way, there's a big correlation, as you know, Richard, that housing and autos really tightly correlated. And you're at a 16 million SAR in autos. So to me, I think housing will improve. And I think the opportunities that you're seeing in the last couple of days from some of the home builders, while I'm not crazy about buying them right this moment, just because they've had such a nice rally, let them settle. Eventually, they will be attractive as well. So I think housing is a really big theme. As I mentioned, manufacturing, onshoring, but I also think aviation is really very powerful. And now I know Boeing is having their issues, and they have had a lot of issues over the last several years. They're going to get them fixed. And here's the thing. You have between Airbus and Boeing, you have a duopoly, and you have 12,700 planes in backlog right now. Boeing has 9 years worth of backlog that they are going to be producing, converting from backlog over the next many years. And so to me, there's no other place that airlines can go. It's funny because the United Airlines CEO today was kind of, beating his chest today and talking a good game, saying how upset he was about Boeing and safety. And by the way, rightfully so. However, there's nowhere they can go. They cannot all of a sudden not take back the orders that they placed with Boeing because Airbus can't make them either as fast as they want to. So to me, that's an area I like a duopoly. By the way, I also like when stocks get really hit, especially number 1 or number 2 in the industry. And I understand the reasons why that Boeing got hit, and it is serious, but I think they'll fix it and they will come out a winner. So that's another piece of manufacturing that I like. Something that is not going to be unfamiliar with you and kind of some of the things you're looking at is cybersecurity. Cybersecurity is an absolute long-term trend, unfortunately.
Sure.
We have cybersecurity companies that are getting cyber attacked. Think about that.
Yeah.
Cybersecurity companies that do this for a living that are getting attacked. That tells you how severe this whole thing is. And these companies, and there are only about 5 of them that are publicly traded, that are large enough that will win. And I think they will win, especially as chief investment officers and chief information officers, technology officers. They can't have 10 different cybersecurity companies and platforms in their company. They don't even talk to each other.
Sure.
So it's complicated and it's not really that successful. So you're seeing a migration to companies really streamlining which providers, vendors they're using. As I mentioned, there's only about 5 public ones that are big enough to have the scale and the size. So I like that theme a lot. And then finally, touched on consumer. I think the consumer, the only time I've ever bet against a consumer, I was super wrong. So I've never bet against them again because we are a nation of spenders. And as long as the job market is as strong as it is, and it is strong, and wages are elevated, especially as inflation comes down, I think you want to own online companies, big box retailers, quality retailers. Then you also want to own some of the services side of the economy too. So I think there are plenty of places to be investing at this point, and that's where I am.
Yeah. It's funny you bring up the cybersecurity, and it takes me back. I was at one of the big kind of lunches for one of the big banks, and they polled the audience on how long does it take for a Fortune 500 company to know they've been attacked, and it was like over 100 days. I mean, that to me, everyone said, oh, 2 hours, 15 minutes. It was shocking. It was incredibly shocking. So I am with you on that. So want to be conscious of your time. I know we've been on for a minute here. I want to bring up, the geopolitical front. Obviously, the macro is really as interesting as it's been in some time. How much does that go into your outlook and your thinking? I mean, Peter and I here have been joking. It's like, look at the price of Brent crude. It's the international benchmark. 4 months ago, it was 15% higher than it is today, despite what we're seeing in the Red Sea, despite what we're seeing with, these ground wars and things like that. So it seems like the market's shrugging it off to a certain extent, but would love to hear how you look at it and how it weighs into your decisions.
And the long-term average of crude is about $40 a barrel. So you're still quite elevated, but to your point, you would have thought we would be much higher, of course. And I think that has to do with the US producers are producing a lot. Yeah. We're producing a lot more than we actually expected them to do. The administration has asked them to do it. Companies are finding opportunities to do it. They're minting money, Richard, at this price of oil. So Exxon and Chevron, just in listening to the CEOs and investing over the years, they're obviously brilliant management teams. They make a ton of money at $35 a barrel of oil. Yeah. So just think about it. And what's interesting to me is in the face of a little bit lower crude, what is the industry and what are the key C-suites of the energy companies doing? They just bought $400 billion of M&A in the past 12 months because they see opportunity, they see value. And while the group, energy, was wonderful, great outperformers 2 and 3 years ago, they massively underperformed last year. I think it's mean reversion, but that's what makes it so interesting. When stocks get out of favor and prices in general are out of favor, what do the CEOs and the boards do? And they're buying. And not only that, but you have the big guys buying. But I do think it's quite interesting to see what the companies are doing in innovation and in technology, and the fact that their free cash flow is so attractive. And what they're doing with the free cash flow is not just doing M&A, but they are buying back stock and they are increasing their dividends as well. And that's what, as a shareholder, I want. I want the combination. I want the panoply of CapEx, M&A, dividends, and buybacks. And so I like energy for this year quite a bit, even in the face of oil prices not really escalating too much. And by the way, we don't want it to escalate too much because we really do want inflation to stay tame.
Sure. So final question, and Peter wanted me to ask you on, the outlook for the New York Jets, but we'll pass on that, I think, for the time being.
Ouch.
Yeah, right. But I guess for the folks on the call and as it relates to the Fed and rates and the consumer, maybe something actionable that our listeners can kind of watch for at home, and things that you watch for as far as, kind of key indicators on the direction of markets.
Sure. So I think it's going to be very important to watch inflation data. And we happen to get an inflation data point this Friday, the PCE, personal consumption expenditures. This is what the Fed this is what their favorite inflation metric is. So to the extent that number comes in lower than expected, that will be good news. I think it will be lower than expected, but it's still above their 2% target. Yep. But I do think that we've made a lot of progress on inflation. Watch jobs. Jobs are really, really, really important because that is the lifeblood of the consumer. And we are at record lows in initial jobless claims. That would be the one series within jobs that's the thing I look at because it's a leading indicator. And please don't look at the weekly number because that is so minutia. Yeah. But if you look at the 4-week moving average, you're at 202,000 weekly jobless claims. A recession is more at 350 to 375,000. So we are a far cry in the jobs world of a recession. Watch it. If it starts to reaccelerate, that is something to watch as well. So I would say inflation and jobs. And why is that? Because that's the Fed dual mandate. They look at jobs and they look at inflation. And so that's what we all of a sudden have to become experts at. But net, step back. If the economy is going to grow and we're going to have a soft landing, earnings should be just fine. I think you want to diversify away from Mag 7. I like some of the Mag 7, but I think there's a lot of better value elsewhere. I like dividend growers. I like companies that spin off companies. And these themes are really, that I mentioned earlier, I think are a lot of places where you just want to do a little bit of digging, which I know you've been doing the same. Sure. Yeah, I was joking with the folks in our investment committee last week. My unfortunate prediction for 24 is that none of the debates of 2023 are going away, right? We just kind of seem to be asking the same questions over and over. But no, well, Stephanie, really appreciate the time, and the advice. Obviously, some very thoughtful remarks and commentary there. So yeah, on behalf of the team and all that are on listening, really appreciate it. And best of luck this year. Thank you. You too. Thanks for having me. Appreciate it. Take care.